Welcome to this explainer. Today, we're unpacking one of the most highly sought-after concepts in personal finance. It's an idea that sits right at the heart of the ultimate financial dream, achieving true independence through passive income. We're going to be looking at the foundational strategies, the stark realities, and the incredible potential of building a portfolio designed not just to grow in value, but to actually pay you a consistent, reliable wage while you sleep.
Okay, let's dive into this. It's the ultimate question every investor asks at some point, right? Can you really quit your day job and live entirely on dividend income? Like, is it genuinely possible to replace a full-time working salary with pure passive cash flow, all without ever having to sell off the assets you worked so hard to accumulate? Well, the short answer is yes, absolutely. But the long answer? That requires stripping away the hype and looking really closely at how this mechanism actually works in the real world.
Section 1. The dividend dream.
So as we know, a dividend represents a direct distribution of corporate earnings to shareholders. Rather than keeping all that capital for internal growth, these companies reward their equity owners with regular cash flow. And honestly, this is the foundational engine of this long-term wealth strategy. When you own a share of a dividend-paying stock, you are quite literally a part owner of that business. As the business generates profits, they just choose to share their success directly with you in the form of regular cash deposits right into your brokerage account. It's really the purest form of long-term wealth building.
And this brilliantly illustrates the core difference between dividend investing and traditional investing. Relying on yield is kind of like harvesting the fruit while leaving the tree completely intact so we can produce again next season. On the flip side, selling off your principal to fund your lifestyle is like chopping down the tree. It might generate a bunch of cash for a little while, but eventually you're depleting the very asset that sustains you. Dividend investing is all about keeping that asset base perfectly intact.
Section 2. Doing the math. Now, whether living off dividends is actually possible for you depends entirely on a specific set of variables. It's basically an equation balancing your portfolio size against your desired dividend yield. But it doesn't just stop there. You've also got to calculate your actual annual living expenses, factor in the taxes you'll owe on those dividends, account for inflation eating away at your purchasing power over time, and finally, gauge the absolute reliability of the dividends themselves. Because if any one of these factors is miscalculated, the whole plan can start to wobble.
Now, what's really interesting about this slide is how these abstract concepts translate into reality. Just notice how the portfolio size requirements shift based on your yield and income targets. If your goal is a modest $40,000 a year and your portfolio yields a very conservative 2%, you need a massive $2 million invested. But if you can safely generate a 4% yield, well, that requirement drops to $1 million. And if you're aiming for a six-figure income of $100,000, you're looking at needing anywhere from $2 million to $5 million, depending entirely on the yield your portfolio produces. The math is pretty stubborn here. There's just no getting around the need for significant capital.
Let's anchor this with a very realistic median target, $1.5 million. If you have a portfolio of $1.5 million, generating a realistic and generally sustainable 4% dividend yield, that produces $60,000 of passive annual income. For a lot of people, $60,000 is that sweet spot. It covers basic living expenses, housing, food, utilities, all without needing to touch a single cent of that principal $1.5 million.
Now, looking at that math, your first instinct might be to just go out and find stocks paying an 8, 10, or 12% yield, so you need way less money up front. But high yields alone aren't rarely the answer. Actually, an unusually high yield is often a massive red flag. It usually indicates that a company's stock price has absolutely plummeted, or worse, that a dividend cut is imminent. The most successful investors don't just chase high yields, they prioritize sustainable dividend growth. They're looking for healthy companies that consistently raise their payouts year after year after year.
Section 3. Navigating the risks. We have to be prepared for some harsh market realities here. Companies can, and they absolutely do, cut their dividends during tough economic times. You're going to face broad market downturns, and you must constantly battle inflation, which silently just erodes the purchasing power of your fixed income. There are also shifting tax considerations depending on how your dividends are classified. Plus, if you invest too heavily in one area, say banking or energy, sector concentration can completely wipe out your income if that specific industry takes a hit. And perhaps most importantly, there's sequence of returns risk. That basically means if the market crashes right when you transition to living off your portfolio, recovering from that can be incredibly difficult. This is exactly why diversification is absolutely mandatory if you want to protect your livelihood.
Novice investors frequently stumble into a few really common traps when trying to build this income stream. They chase those dangerously high yields we just talked about, completely ignoring the safety of the underlying company.
They forget to calculate inflation, realizing way too late that a $40,000 income 10 years from now won't buy nearly what it does today. They failed to diversify, and they expect quick, get-rich-quick results. Look, dividend investing is the exact opposite of getting rich quick. It requires recognizing that ignoring your total return in favor of just the immediate cash payout is a literal recipe for long-term stagnation.
Section 4. Building the blueprint.
So the crucial point is that this is a very systematic process. Step 1 is focusing on dividend growth investing, actually buying companies with a proven track record of increasing their payouts. Step 2 is the real growth engine, reinvesting all your dividends during your accumulation years. When you take the dividends and use them to automatically buy more shares, those new shares then pay their own dividends. It creates this amazing compounding snowball effect that rapidly accelerates your wealth. Step 3 is demanding a diversified portfolio. And Step 4 is anchoring that portfolio with blue-chip companies that have long, multi-decade histories of weathering financial storms while continuing to pay out to their owners.
Let's move to and see how this builds a strong foundation using a hypothetical, well-diversified sector portfolio. Keep in mind, this is purely conceptual just to illustrate the mechanics, definitely not specific financial advice. But notice the balance here. You have consumer staples, things people buy no matter what the economy is doing. You have healthcare, which is a massive and essential industry. Utilities, providing those consistent, regulated cash flows. Financials, like robust, established banks. And finally, REITs, bringing real estate exposure into the mix. If one of these sectors has a terrible year, the other four are right there to keep your income perfectly steady.
Now, I do want to single out that last sector briefly. Real estate investment trusts, or REITs, are fantastic tools for dividend investors because, by law, they have to pay out the vast majority of their taxable income to shareholders, and that usually results in significantly higher yields. However, they come with unique mechanics. They're highly sensitive to interest rate changes, and crucially, their dividends are often taxed differently, usually at your ordinary income rate, rather than the more favorable qualified corporate dividend rate. So they're powerful for sure, but you really must understand those tax implications before making them a core part of your strategy.
To protect this entire system, the absolute ultimate safety net for a dividend investor has nothing to do with stocks at all. It's maintaining a robust, liquid cash emergency fund. By having several months, or even a year or two, of living expenses sitting in pure cash, you ensure that if the market takes a massive dive, and a few companies temporarily pause their dividends, you're never forced into the devastating position of having to chop down your income-producing trees just to pay your rent. You absolutely must protect your principal when the unexpected happens.
Section 5. The long game.
Building a portfolio capable of completely replacing your income is the ultimate financial marathon. It demands incredible patience, unwavering discipline, and a deep focus on consistent, steady growth over decades. If you treat this like a sprint, chasing maximum yield, panicking during market drops, expecting life-changing results in just a couple years, you are likely going to be very disappointed. But if you embrace the marathon, every single share you buy today is literally a brick laid right into the foundation of your future financial independence.
To summarize our definitive key takeaways from this explainer, yes, living off dividends is absolutely possible, and it's a reality for many disciplined investors right now. However, it requires a significant amount of capital, which obviously takes time to accumulate. Always remember that sustainable dividend growth and consistency will beat chasing high yields every single time. And ultimately, your success isn't just going to come from the stocks you pick, but from the long-term discipline you practice while holding them.
Which leaves us with one final, incredibly important question for you to consider. Based on your current savings rate and the math we've looked at today, what does your personal timeline for financial independence actually look like? I invite you to take a hard look at your own portfolio, run the numbers for yourself, and continue educating yourself on this incredible wealth-building strategy. Because planting those trees today is really the only way to ensure you'll have apples to enjoy tomorrow.